Hey, Morgan. Conventionally, it takes about 6 months before volatility in the public markets begins to really trickle into the private markets. That's 2 consecutive quarters where persistent correction is there. The reason why is we've seen this convergence between the public markets and the private markets with investors that participate in both. So what happens is when you see mutual funds losing money in their public market investments, they start to rein in the investments in their riskier private market investments, and that takes liquidity out of that system. Earlier today, we spoke with a prominent investor who participates in both the public and private worlds about this very phenomenon. Here's what he says.
I suspect that what will happen if and when we do have our next market correction is some of the capital that's in the private market will slow down, but the merger of these markets are going to maintain. With that said, I suspect that if the markets are strong in 19 will be a very big IPO year.
Now, we are here at Half Moon Bay at a tech conference put on by JP Morgan called Revolution. We spoke with the vice chairman of JP Morgan, Noah Wintrob, about what this means for the IPO prospects in 2019.
At JP Morgan, we have not seen anybody change their view of their timing or expectation given the markets. I think we'll see in what happens in 2019, what happens on a macro basis, and what the market is doing. And if the market is super volatile, people may change their plans.
He said that oftentimes smaller companies are more susceptible to that volatility than larger companies. Guys, back over to you.
Leslie, this is such a key conversation to be having right now because when we do set our sights in 2019, there's quite a number of multi-billion-dollar mega tech unicorns that are expected to go public. Right now. I wonder if, just to sort of like play devil's advocate here, the fact that we are seeing as much market volatility as we are would actually accelerate those plans.
Well, the challenge for these companies in going public in a super volatile market is it's really, really difficult to find the appropriate price. Because when you price a company that's never been public before, which we'll see, of course, with Uber when they go public and Lyft when they go public, is you have to find a comparable place in the public markets to do that. And if it's volatile, it becomes very difficult, Morgan.
All right, Leslie, we will certainly watch high stakes for next year in the IPO market.